Ever wonder how those day traders make sense of like the market moving so fast?
Yeah.
We're about to
Yeah.
we're about to find out.
Yeah.
In this deep dive, we're going to be analyzing a YouTube video from the Inner Circle Trader,
Okay.
specifically episode 9 of their 2022 ICT Mentorship series.
All right.
So think of it as like we're peeking behind the curtain
Yeah. Yeah.
to see how a pro analyzes and predicts market swings.
Right.
And you might be surprised what we learn,
Mm-hmm.
even if we're not planning to become day traders.
What's fascinating here is how this trader uses a framework that he calls the Power 3,
Okay.
accumulation, manipulation, and distribution,
Power 3.
to understand market cycles. It's like a roadmap for navigating the ups and downs of a trading day.
It sounds kind of intense.
Yeah.
So is accumulation, like when the market's quiet, but smart money is like secretly buying up assets before everybody else catches on.
Exactly.
Okay.
Think of it as a stealthy period where informed traders are identifying potentially undervalued assets and gradually building their positions.
Right.
They're not just looking at the current price. They're anticipating where it might go based on subtle cues and market indicators.
So they're playing chess while other folks are playing checkers.
100%.
They're like spotting the patterns before they're obvious.
Yeah.
Okay.
Yeah.
So then comes manipulation.
Right.
What's that all about?
This is where things get really interesting. The trader points out patterns like what is called the Judas swing.
That's a swing.
Yeah, a sudden, deceptive price drop designed to trigger stop-loss orders from other traders.
Wait, so they're intentionally trying to mislead other traders?
In a way, yes. See, when a lot of stop-loss orders are triggered at once, it can create a domino effect, driving the price down even further.
Okay.
These traders who understand this dynamic are ready to buy up those assets at an even steeper discount.
So they're using the fear
Yes.
and the psychology of the market to their advantage.
Psychology is huge in the market.
It's like a high-stakes game of poker.
Absolutely. And he even uses specific examples from February 14th and 15th of 2022, where he identified these patterns in real time while trading the NASDAQ E-mini futures. He breaks down how he noticed a Judas swing right around the 8:30 a.m. opening bell on February 14th.
Wow.
And how he used that to anticipate a price drop.
Okay.
Yeah.
And that's just the manipulation phase.
That's just one.
What about distribution?
Yeah.
Does that come after the price has been manipulated upward?
Exactly. Once the price has been strategically driven up, those who accumulated early begin to sell their holdings, ideally for a profit.
Right.
They're essentially riding the wave they helped create, taking advantage of the price difference.
Okay, so let me get this straight.
Yeah.
So the trader identifies an asset that seems undervalued.
Right.
And that's during the accumulation phase.
Correct.
Then they might use tactics like the Judas swing to manipulate the price, trigger those stop-loss orders,
Right.
create a buying opportunity,
Yeah.
and then they ride that price wave up
That's right.
and distribute their holdings at a profit.
You got it. It's a cyclical process.
Wow.
And this trader claims to use it to identify potential trading opportunities throughout the day.
Okay.
But it's not just about recognizing these broad phases. It's about understanding how to apply them in real time, which is where things get even more complex.
So how does he do that?
Yeah.
How do you actually spot these Power 3 phases playing out in the chaos of the market?
It's a good question.
Like, he can't predict the future, can he?
Well, he doesn't have a crystal ball.
Right.
But he does have a keen eye for patterns and what he calls imbalances.
Imbalances.
Yeah, he's constantly looking for discrepancies
Okay.
between buying and selling pressure, which he believes offer clues about where the market might be headed next.
So he specifically mentions these imbalances in order blocks
Yes.
in his analysis of the NASDAQ E-mini futures.
That's right.
Can you explain what those are
Yeah.
and why they matter?
So order blocks are basically large orders placed by institutional traders that can signal a shift in market direction.
Okay.
Think of them like big waves that can move the entire tide.
Okay.
This trader watches for them carefully
Okay.
because they can create those imbalances he's always looking for.
So if he sees like a big order block coming in
Yeah.
on the buy side, he might interpret that as a signal that the price is about to go up?
Exactly.
Okay.
He's piecing together these clues, these patterns and imbalances to get a sense of the market's next move.
Right.
It's like he's reading the language of the market.
Gotcha.
And those order blocks are like flashing neon signs.
But it's still a gamble, though, right?
Of Of course.
I mean, even with all this analysis,
right,
there's no guarantee that the market will move in the direction that he predicts.
well, you're absolutely right. And that's where his emphasis on risk management comes in.
Okay.
But we'll dive more into that in a bit. For now, let's go back to how this trader uses the Power 3 to make those split-second decisions.
Sounds good to me. Let's get even deeper into this.
All right, so we've got these Power 3 phases, the importance of spotting imbalances, and the significance of order blocks. Now, let's talk about how these all come together when the trader is looking at specific market events.
Perfect. I'm ready for more. All right, so you're saying this trader is watching for those order blocks and imbalances.
Right.
To see if they kind of like confirm what he's observing in the Power 3 phases.
Right.
It's like he's got this internal checklist he's like running through in real time.
100%. And remember how he highlighted those fair value gaps?
Yeah.
Those gaps in price between a stock's closing price one day and its opening price the next day.
Right.
He uses those as additional clues to anticipate where the price might be headed.
Yeah, he talked about those gaps in the video.
Yeah.
I'm still a little fuzzy on how he actually uses them.
Okay.
Like, it sounded like he's almost looking for situations where the market overreacted.
Exactly. He believes those gaps often indicate that the market has overshot in one direction or another, either up or down. And based on his analysis, he'll often make a trade, anticipating that the price will eventually revert back towards a more reasonable level.
So he's like a market therapist.
Right.
Spotting those moments of irrational exuberance or panic.
Yeah.
And then betting on the market to return to a more balanced state.
That's a great way to put it. And this is where his emphasis on reading market sentiment comes in.
Okay, so he's not just looking at charts and numbers all day.
No.
He's also trying to get inside the heads of other traders.
Precisely. He talks about the importance of understanding the collective mood of the market.
Okay.
Why are people buying? Why are they selling? What are they reacting to?
So he's like scrolling through Twitter, watching the news, trying to gauge the overall vibe.
Exactly. News events, economic indicators, even rumors can all influence trader behavior.
Right.
And this trader believes that by understanding those factors, you can get a better sense of where the market might be headed next.
That makes sense.
Yeah.
It's like he's factoring in the human element of the market.
100%.
Which can be pretty unpredictable.
Absolutely. And that's why he emphasizes discipline and patience as being crucial for success in day trading.
He did seem adamant about that in the video, talking about how you can't get emotional or get caught up in like the heat of the moment.
Yeah.
Easier said than done.
Especially when you see those prices moving so quickly.
Right.
But he argues that one of the biggest mistakes traders make is chasing the market.
Oh.
Meaning buying into an asset that's already skyrocketing in price out of fear of missing out.
Oh, yeah?
Yep.
He actually told that funny story about getting up to like grab a drink.
Right.
And missing a trade.
Yeah.
Because the market moved so fast while he was gone.
It happened.
I guess even the pros get caught off guard sometimes.
It just goes to show that no one can predict every move perfectly.
Right.
Even with all the analysis in the world,
right,
there's always an element of chance.
Yeah.
That's why he focuses on managing risk and never betting more than he can afford to lose.
Right.
He'd rather miss out on a potential gain than take a big loss.
And that ties back to his emphasis on discipline, right?
Yes.
Knowing when to stay out of the market is just as important as knowing when to jump in.
Absolutely. He specifically cautions against chasing those big overnight runs where a stock might surge in price after hours.
Yeah, he seemed wary of those moves in the video.
Yeah.
Why is that?
Well,
it seems like a good thing if a stock is going up, right?
Not necessarily. He argues that those overnight runs can create false expectations for the rest of the trading day.
Oh.
He'd rather wait for the market to settle, to reveal its true intentions before making a move.
So he's not afraid to miss out on those initial gains.
Correct.
He's playing the long game, waiting for a better opportunity to present itself.
Exactly. He'd rather wait for a pullback or a more favorable entry point.
Okay.
Remember those New York lunch lows he mentioned? Yeah. He sees those as potential buying opportunities because they often represent a dip in price that happens around lunchtime in New York when European markets are closed.
So he's looking for those moments when the market might be taking a bit of a breather.
Yeah.
And then using his analysis to determine whether it's a good time to buy?
Exactly. He's not just blindly buying when the price dips. He's using those fair value gaps, those order blocks, and his understanding of market sentiment to assess whether the dip represents a genuine opportunity or just a temporary blip.
It's amazing how much information he's processing in real time. It's like he's speaking a different language.
Yeah.
But the more he breaks it down, the more sense it makes.
It definitely takes a certain mindset and skill set to be successful at day trading. But even if you're not planning to quit your job and become a day trader tomorrow,
right,
there are some valuable takeaways here for anyone interested in the markets.
Totally. I mean, even for a long-term investor like myself,
Right.
his emphasis on risk management, patience, and understanding market psychology is incredibly insightful.
Absolutely. And that's what makes this deep dive so fascinating. We're not just learning about the technical aspects of day trading.
Right.
We're gaining a deeper understanding of how markets work, how traders think, and how even in a world of algorithms and high-frequency trading, human psychology still plays a massive role.
It's like we've been given a secret decoder ring for the market.
Yeah.
Okay, maybe not secret.
Right.
More like we sat in on a masterclass.
Yeah.
And got a glimpse of how the pros think.
And what's interesting is how much of his approach, while it's tailored for day trading, applies to a broader understanding of market dynamics.
Right.
Even if you're a long-term investor, understanding those power 3 phases can be insightful.
Yeah.
You might start noticing them on a larger timescale.
Right. Like instead of happening within a single trading day, maybe accumulation plays out over weeks or months leading up to a major product launch.
Exactly.
And then the hype builds, maybe some news drops.
Yeah.
And boom, that's the manipulation phase driving the price up.
Exactly.
And when the news hits peak saturation, like everybody and their cousin has heard about it.
Right.
That could be when distribution starts, as early investors decide to cash in.
Right. 100%.
Wow. Never thought about it like that before. It's like those same patterns repeat on different scales.
They do. Yeah.
And recognizing those patterns can help you make more informed decisions.
Yes.
Whether you're a day trader making split-second moves or a long-term investor with your eye on the horizon.
That's right.
That's what I love about these deep dives. It's not just about learning a bunch of facts. It's about gaining a new perspective, a new way of thinking about things. It's almost like we've upgraded our mental operating systems.
Exactly. And with this upgraded OS, you are better equipped to navigate the complexities of the market, whatever your investment style may be.
This has been an incredible journey, and I feel like I've learned so much.
Good.
But even with all this analysis, I keep coming back to something this trader said.
Yeah.
Don't chase the market.
Yeah.
It's simple, but it's so profound.
It really is. In a world of instant gratification and FOMO, remembering that sometimes the best trades are the ones you don't make can be the hardest lesson to learn.
And that's advice we can all take to heart, whether we're navigating the stock market, making career decisions, or even just choosing what to have for dinner.
Right.
Sometimes patience and discipline are the keys to success.
Well said. Sometimes stepping back, observing, and waiting for the right opportunity is the smartest move you can make.
That's a perfect note to end on. To all our listeners out there, thank you for joining us on this deep dive into the world of day trading. We hope you've gained some valuable insights and a fresh perspective on the markets. Until next time, remember, stay curious, stay informed, and as always, happy investing.